The silver market is frozen right now. But before trading resumes Sunday night, one headline from the Middle East, Washington for Asia, could violently change where prices explode next. And here's the dangerous part. By the time most investors see the news alerts Monday morning, the move may already be over. That is why this video matters tonight. Because what happens before futures reopen could determine whether silver gaps sharply upward or gets crushed before breakfast. Right now, traders are staring at a setup packed with tension. Futures closed for the weekend, volatility compressed, and global uncertainty stacked on top of an already strained silver market. The financial networks are quiet for the weekend. Analysts are offline, but the forces moving this market are still active behind the scenes. So in the next few minutes, I'm going to show you exactly what professional traders are watching before markets reopen, why silver is trapped between two massive economic forces, and what kind of move could hit next week. Before we dive deeper, if you appreciate real macro breakdowns without hype, hit the like button and subscribe to Financial Freedom Desk. This channel tracks the structural side of the economy, not just headlines. Silver closed Friday near $75 per ounce after another week of sideways movement. On the surface, the market looked calm. Daily swings narrowed. Price action slowed. Financial websites described it as stability, but that interpretation misses the bigger picture completely. This is not calm. It is pressure building beneath the floorboards. Markets sometimes move the hardest after periods of silence. Compression creates tension, tension eventually releases, and silver right now is sitting directly between three unresolved global developments that could trigger a major repricing in a matter of hours. Markets sometimes move the hardest after periods of silence. Compression creates tension. Tension eventually releases, and silver right now is sitting directly between three unresolved global developments that could trigger a major repricing in a matter of hours. The first is a geopolitical situation surrounding Iran and energy markets. The second is inflation expectations inside the United States. And the third is the growing conflict between industrial demand and monetary policy. Those three forces are colliding simultaneously. And if even one of them breaks unexpectedly over the weekend, silver could open Monday with a move that shocks traders on both sides. Let's begin with the biggest variable, oil and Middle East negotiations. Throughout the past several days, conflicting reports emerged about possible diplomatic progress involving Iran and Western officials. Some reports suggested negotiations were moving forward. Others warned that major disagreements remained unresolved. That uncertainty whipped oil markets violently. Midweek, crude prices dropped sharply after comments suggesting diplomatic progress was possible. Tanker traffic through critical shipping routes appeared to improve. Investors briefly believed the worst-case scenario might be fading. Silver bounce was then doubts returned by Friday. Energy traders began questioning whether a real agreement actually existed or whether markets simply reacted too early. Oil recovered, precious metals pulled back again, and suddenly the entire weekend became a waiting game. Here's why this matters so much for silver. If tensions ease significantly and oil prices fall hard next week, inflation pressure immediately cools. That changes expectations around Federal Reserve policy. Lower inflation expectations reduce pressure for aggressive interest rates, and lower rate pressure historically benefits precious metals. Silver reacts fast to those shifts because it sits between industrial demand and monetary psychology. But what if negotiations fail? What if talks collapse completely? What if oil spikes back above critical levels? What happens if shipping risks intensify again? Then the inflation problem comes roaring back into focus. Higher oil means hotter transportation costs. Hotter transportation means more pressure across manufacturing, food, shipping, and consumer pricing. The Federal Reserve then faces even more pressure to stay restrictive. And restrictive policy creates a headwind for silver. That is why Monday's open matters so much. A diplomatic breakthrough could ignite a rally. A collapse in talks could trigger another wave of selling. And if nothing concrete emerges at all, silver probably remains trapped in the same tense range while traders wait for the West. Next, economic catalyst. But underneath all of that, something even bigger is happening. Silver is being pulled apart by two completely different identities. Most investors think of silver as simply a cheaper version of gold. That's incomplete. Silver has a dual personality. One side is monetary, the other is industrial. The monetary side reacts to inflation, interest rates, bond yields, and the strength of the dollar. The industrial side reacts to manufacturing demand, solar production, electric vehicles, artificial intelligence infrastructure, electronics, and energy systems. Normally, those two forces work together. When rates are falling and industrial demand is growing, silver becomes incredibly powerful because both engines push in the same direction simultaneously. That is exactly what fueled silver's explosive rise through previous bull cycles. But recent geopolitical shocks disrupted that balance. The industrial side of silver remains strong. Global electrification still requires massive quantities of conductive metals. Solar manufacturing continues consuming huge amounts of supply. Artificial intelligence, infrastructure expansion is increasing electricity demand worldwide. Those trends did not disappear. What changed was the monetary side. When oil surged earlier this year, inflation fears reignited. Central banks became cautious again. Bond yields stayed elevated. Suddenly, the opportunity cost of holding precious metals increased. The monetary tailwind weakened dramatically, so silver became trapped. Industrial demand continued supporting the market underneath, but monetary conditions prevented a clean breakout of higher. That tension explains why prices have repeatedly struggled near major resistance levels despite long-term bullish fundamentals. Now here is where things become fascinating. If energy pressure fades and inflation expectations cool simultaneously, the monetary engine restarts while industrial demand remains intact. That combination could create explosive upside. Markets move hardest when confidence changes suddenly. Think about the implications for a moment. A metal already facing structural supply tightness suddenly regains monetary momentum. At the exact same time, industrial demand remains historically strong. That is the setup many institutional forecasts are quietly anticipating. And the data supporting the supply side has not disappeared. Industry reports continue showing persistent deficits between silver production and global consumption. Physical inventories remain under pressure. Large portions of refined supply remain concentrated inside a handful of countries. Meanwhile, industrial users continue locking in material for long-term manufacturing needs. That is why silver keeps attracting strategic attention despite volatility. Now let's discuss another critical piece of the puzzle that most casual traders overlooked this week: inflation expectations data. Recent consumer surveys showed a slight moderation in future inflation expectations. Not a collapse, not a victory declaration, just the first small hint that inflation psychology might not be accelerating as rapidly as feared earlier. Why does that matter? Because expectations influence behavior. If consumers expect runaway inflation, wage demands increase. Businesses raise prices more aggressively. Policymakers react more forcefully. Markets then price tighter financial conditions. But if expectations stabilize, pressure eases. That is why traders cared so much about the latest readings. They are searching desperately for clues about whether inflation momentum is cooling or becoming entrenched again. And silver traders know the answer directly affects Federal Reserve policy expectations. If inflation expectations continue easing while energy prices calm down, the market starts imagining a friendlier environment for precious metals. If inflation expectations surge again, alongside higher oil, silver faces renewed resistance from elevated yields and tighter policy expectations. This is why the current setup feels so unstable. Multiple macro forces are hanging in balance at the exact same time. Now let me show you the broader framework serious investors are watching heading into next week. Gold remains elevated historically. The gold-to-silver ratio still sits above levels many analysts consider normal during strong precious metals bull markets. Several major institutions continue maintaining aggressive long-term gold targets. Despite recent volatility, why does that matter for silver? Because historically, when gold strengthens and the ratio compresses, silver often accelerates faster, sometimes dramatically faster. The mathematics behind many bullish silver forecasts are not mysterious. They are based on two assumptions. First, gold prices continue rising over time due to monetary instability, debt concerns, and central bank demand. Second, the gold-to-silver ratio eventually narrows closer toward historical bull market averages. If both happen simultaneously, silver prices reprice aggressively. That possibility is exactly why investors continue monitoring this market so closely despite violent short-term swings. But none of this happens in isolation. Next week's economic data could either reinforce or weaken the entire thesis. Growth numbers, labor market data, inflation indicators, bond yields, and Federal Reserve expectations are all feeding into the same machine simultaneously. Weak growth combined with stubborn inflation creates stagflation fears. Strong growth with easing inflation creates optimism. Weak growth with cooling inflation increases hopes for policy flexibility. Each path affects silver differently. And remember, Futures reopen before most people fully process any of it. That is why preparation matters more than prediction. You do not need perfect certainty, you need a framework. You need to understand what variables actually drive this market instead of reacting emotionally after prices already move. Here's another question worth asking. Why has silver remained surprisingly resilient despite aggressive rate pressure this year? Because underneath the paper market noise, structural demand has not vanished. Manufacturers still need conductive materials. Governments still push electrification agendas. Renewable infrastructure still consumes enormous amounts of silver. Data center expansion still requires massive electrical capacity, and mine supply cannot instantly scale higher on command. That supply rigidity matters enormously. Most silver production arrives as a byproduct from other mining operations, like copper, lead, or zinc extraction. Producers cannot simply double silver output overnight because prices rise temporarily. Supply responds slowly. Demand, however, can shift quickly. That imbalance is one reason silver tends to move violently once momentum returns. The quietest charts often hide the largest moves. Now, none of this means silver only goes upward. Let's be honest about risks. A stronger dollar could pressure metals again. Economic contraction could weaken industrial demand temporarily. Geopolitical stress could keep inflation elevated longer than expected. Central banks could remain restrictive well into next year. Those are real risks, and traders ignoring them are not investing responsibly. But markets are forward-looking machines. They constantly attempt to price tomorrow before tomorrow arrives. That is why the next 72 hours matter disproportionately. If energy fears fade, inflation expectations soften, and markets begin pricing a less aggressive monetary path, silver may finally regain both of its engines simultaneously. If the opposite occurs, volatility intensifies and pressure remains. Either way, Monday's reopening could become one of the most important sessions of the month. Now let's step back and look at the bigger historical context. So, every major silver bull phase in modern history shared one common ingredient: a shift in belief. Not just fundamentals, not just charts, belief. When investors suddenly realize monetary conditions are changing while physical demand remains firm, silver can reprice far faster than most expect. And because the market is relatively small compared with other global asset classes, flows move prices aggressively. That is why silver rallies often feel chaotic once they begin. The market spends long periods compressing, then suddenly explodes. Right now we are in another compression phase. Volatility narrowed this week, price stalled, headlines conflicted, traders hesitated, but beneath the surface, macro pressure keeps building. That pressure will eventually release somewhere. Maybe diplomacy calms energy markets, maybe inflation data improves, maybe bond yields retreat, maybe industrial demand overwhelms expectations again, or maybe stress deepens first before conditions stabilize later. But either way, pretending nothing important is happening because silver traded sideways this week would be a massive mistake. This market is loaded with tension, and tension never stays quiet forever. So, heading into Sunday night, here is what matters most. Watch energy headlines closely. Watch bond yields. Watch inflation expectations. Watch how futures react immediately after reopening. And, most importantly, watch whether silver begins acting like a two-engine market, again instead of a one-engine market, fighting monetary resistance. Because if both forces align at the same time, price discovery could accelerate quickly. And if you wait for mainstream media to explain the move afterward, you will already be late. That is the reality of fast-moving macro markets. Before we close, if this breakdown helped you understand the bigger structure behind silver's next move, make sure you hit like and subscribe to Winds of Thought. Share this video with anyone holding precious metals right now, because the next few trading sessions could reshape sentiment very quickly. And I want your opinion below. Do you believe silver breaks upward once energy pressure cools? Or do you think inflation keeps blocking momentum longer than investors expect? Tell me in the comments. The market is entering a critical window. Stay alert, stay rational, and stay ahead of the crowd. I'll see you in the next one. End.